morning. But again, the market's really just kind of consolidated for the most part yesterday. Did have a loss for the day, but mostly just a consolidation day. And again, not surprising after such a very strong week last week. Last week up 6.5%. Nice bounce off these lows, coming up to challenge the 20-day moving average. This morning, futures are pointing higher. Dow's up about 190 points right now. NASDAQ up 62. S&P is going to be up a little bit as well this morning. So we're going to try to see another attempt here at the 20-day moving average. Again, as we talked about yesterday, one of the reasons for the rally that potentially this week, this kind of carry through rally, if we get it, is because of this quarter end rebalancing. About $30 billion needs to get put to work by the end of this week, as all these mutual funds, hedge funds, pension funds, etc., have to issue out their quarterly reports. So they have to be allocated accordingly. A lot of these managers underweight equities, obviously, because of the sell-off in the markets this year. But again, seeing a bit of a rally here. We'll see if we can get some follow-through on that today. Also, we've got buy signals kind of across the board right now. That's giving some lift to the markets. But as we've talked about, don't mistake this rally as the bottom, right? This is another opportunity, and we've talked about this repeatedly this year so far, is using these rallies as opportunities to rebalance risk, take some money off the table. You can trade these rallies. We had a little bit of exposure at yesterday's lows to our portfolios, and we're going to kind of trade this rally for the next day or two, and then we'll take that exposure back off. You can trade these rallies, but this isn't the place to start trying to add a lot of exposure thinking we're at the bottom. We're not there just yet. And there's a couple of reasons for that. First of all, economic growth continues to come in much weaker than expected. Yesterday, we had a very weak report from the Dallas Fed Manufacturing Index. Durable goods were a little bit better. That showed a slight uptick, more than expected. But a lot of that is because of the demand pull right now that's still kind of coming into the economy. So businesses are still trying to keep inventories in. They're still worried about supply shortages. So there's still some areas of the economy where demand for certain goods and services is pulling forward some of those durable type orders. So we're seeing some of that pull on that side. However, on a lot of the retail side, on the consumption side, lots of weakness there. Retail inventories very high right now. Sales are starting to decline because of an inability for consumers to pay for much higher prices due to inflation. And this is something we're going to get into this morning, talking about, and this particularly talking about inventories, is what we'll talk about this morning called the bullwhip effect, because that is something that we actually talked about back at the very beginning of this whole cycle, and particularly after the Biden administration passed their $1.4 trillion stimulus bill in 2021, we talked about the sugar rush economy and how you have this big rush of activity because of all this liquidity, but then you get this bullwhip effect coming back, which is, if you think about how a bullwhip works, right? It goes out, coil, snaps, comes back very quickly. That's the economy that we're in right now. We're having this effect. So we'll talk about the impacts and importance of the bullwhip effect this morning and what that means for economic growth. But the big challenge here is going to be for equities is that earnings estimates, and this is our article that's on our website today. We have an article out today talking about an earnings recession. And this is because economic growth is slowing, but analysts have not revised lower their earnings estimates. So since earnings are derived from what consumers spend in the economy, as the economy slows, as consumers spend less, those earnings estimates have to come down. And that is just going to be a function of time now until that happens. So as earnings estimates come down, that's going to put more downward pressure on prices as valuations have to adjust. So this is why continuing to say here, use these rallies as opportunities to reduce risk, rebalance your portfolio. This isn't the time to be overly aggressive. We'll have some nice little tradable bounces here, but outside of that, it's going to be more risk to the downside, at least for the time being. Now, as we get further into the summer, particularly into the fall, we will likely start to get much better clarity on a few things here in terms of inflation, what's happening with that. It's likely we've seen a peak of inflation. We'll start to see that come off. Oil prices have come off here recently. That's going to help that inflationary number come down. Housing prices are coming down. Those run a lag, so that's going to start those lower home prices are going to start to feed into inflation over the next couple of months. So likely we've seen the peak of inflation. That's going to put some more pressure on the Fed on terms of hiking rates. And in fact, we're already starting to see analysts and market futures expect rate cuts by the beginning of 2023. Now that could even get pulled forward into later part of this year into 2022 if we begin to see more of a recessionary impact setting into the economy. And again, while a lot of headlines are talking about the inevitability of a recession, recessions aren't inevitable. There's always a possibility we could avoid a recession, but there's a lot of indications that suggest a recession is coming in terms of a lot of the economic data that we're seeing already. So this is why earnings estimates will have to come down. That is going to put more pressure on equities as we get there later this year. So again, continue to moderate your portfolio risk, manage that risk accordingly. Be some good trading opportunities in here like we just saw kind of over the last few days. But again, these trading opportunities are likely to be limited. And right now, the top of this trading channel is going to be right around 4,000 on the S&P 500. So this rally's got a little bit more left to it potentially to get back to overbought conditions. But around 4,000, we're going to start to see that downward pressure of the 50-day moving average and other resistance levels at that level really kind of meet, sellers that have been trapped in this market that want to get out. So again, keep watching the risk. We'll come back after the break. We'll talk about the bullwhip effect and what that means for the economy later this year. I'm Real Science Roberts. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hurricane season is here.